Hello and welcome to Kemet Capital, a community of holders and seekers of African capital. I'm your host, JS, and as you guys already know, before we start, we begin with our word of affirmation, guiding principle, Cobb and Douglas production function. On our way to make Africa great again is through economic might, economic power, and for that, we need to produce more in a more efficient way. The topic of today's talk pertains to the total factor productivity, which is the change in output, not from input. Angola hit with 200 million JPMorgan margin call as African bonds tumble. Oil producing nations inject cash to shore up loan after crude prices slump. Joseph Cotterill in London, it's the emerging market correspondent for the Financial Times. Let's jump in. Angola injected nearly 200 million to shore up $200 million at that, to shore up a 1 billion loan from JPMorgan that was backed by the country's bond after the dollar debt of the oil producing African nation tumbled with crude prices in the recent global market rout. JPMorgan, as I'm pretty sure you guys are familiar, it's wholesale. It started as a merchant bank with Junius Spencer Morgan, father of John Pierpont Morgan, who gave its name to the company. So the bank um, is used to started in the 19th centuries as providing loans to sovereign nations in South America, in Europe, and also participated in the war effort during World War One before the U.S. Um, uh, joined the fight against Germany and the other powers. So this is JP Morgan. So just to say that they used to make loans to sovereign nations, as I said, since the early 19th centuries or late 19th centuries at that. Angola's finance ministry told the Financial Times on Friday that it used the cash to meet a margin call on the loan as volatile oil and debt markets hit the value of about $2 billion in debt that was used as security. Okay, let's take a quick step and discuss about what is a margin call. All right, a margin call happens when the value of an investor's margin account is the account borrowed with leverage, falls below the required minimum level, known as the maintenance margin. So this is a diagram that I was able to put together. You have the margin call. So this is the investor here. He has his own funds, equity. He has a loan. He borrows, so he has the leverage. He purchases security. Now that security decline in value. The broker that lent him the money or the security is now calling him like, hey, the value of your security is dropping. You need to replenish the equity in this transaction. So in order to do that, you deposit funds or you sell assets. Right. To visualize exactly what a margin call scenario looks like, we have this quick example. So you want to buy $20,000 worth of security. Could be stock, bond, or any other physical asset, gold or whatnot. So you have your $10,000 in equity and you borrow $10,000 on margin. So your split between debt and equity, your debt and equity ratio is 50%, right? So this is the initial margin. Now, as we said here, there's a maintenance margin, right? The maintenance margin in this case is 30%, which means when the stock prices or the stock of your asset drops, if the value of your equity is now less than 30%, your broker is going to make a margin call. It's going to make a margin call for you to bring back your equity to maintain the minimum 30% requirement, right? Does that make sense? So you borrow the asset, you borrow 20,000 worth of asset. Now your asset is worth $12,000. So you lost $6,000 or $8,000 of value. But the loan is still the same. Loan is still the same. The loan doesn't drop with value. The loan is a loan. You have to pay it back, right? But then again, here your value of your equity is too low compared to the size of the position, right? Your position is $12,000. You only have $2,000 in equity. The broker doesn't like that. He wants you to be involved to a certain point. And that points for him, the minimum is 30%. So some margin calls will require you to bring back the margin to 50% instead of the 30%. So instead of uh, uh, 1,600 that you're putting, you have to put, you know, 6,000. You have to put, it has to be 50-50 between the two, basically. So this is a scenario of a margin call, so that just everybody's aware of what we're talking about throughout this article. For Angola, this has led to our bonds trading at a discount, triggering the need for a margin call. So, as we were saying, the value of the bond dropped, and then JP Morgan wants them to bring back the equity side of the asset of yeah, the equity side of the ownership to 30% to the minimum, triggering the need for a margin call, which we have fulfilled promptly and in cash, which is good. Brokers, they like when you fulfill your margin call in a timely manner and ideally with cash. Angola respects its contractual obligations. You know, guys, in banking, the most important element is character. If you cannot prove a lender that he'll be made whole in his investment to you, your reputation is doomed and you'll never get on the market again, or at least at a higher cost if you don't pay back. If you don't pay back the lenders in a timely manner. JP Morgan declined to comment. They don't have to comment. The margin call on Angola reflects the financial strain that this week's turmoil across markets is imposing on poorer nations that were already struggling to bring down double-digit costs to issue new debt. Prices of Angola's other dollar bonds fell sharply this week, sending their yields to just under 15% on Friday, after a plunge in crude prices just over $60 a barrel on fears of a global recession over Donald Trump's tariffs. Oof, Donald Trump's tariff causing havoc to everyone in the US as well. This guy, I'm not even sure if he understands what's going on. What's the tariff? What's the role of the tariff? Is it good for free economy? Is it free for a liberal economy that was promoted by the US for the last 40, 50 years? Who knows? But Donald Trump, right now, you don't look that smart. Out of the deal, I'm not sure about that. Prior to the sell-off, President Yahoo Lorenzo's government had been working to regain access to bond markets, signaling that it did not intend to ask the IMF for a bailout and sounding out investors on a potential issuance. As you guys already know, the IMF in this community was considered as a vulture fund, you know, as a lender of last recourse. They impose, stringent or harsh austerity measures. They imposed expense regulation, uh, transfer from the government to the population basically stops when the IMF comes around. So not good when you're dealing with the IMF. It's a very bearish signal that you're giving to the market. Yields for Gabon, another African oil producer, also rose to about 15% this week, as preparations by OPEC for an increase in output over April and May also hit oil prices. Angola quit the oil producers cartel in 2023. I mean, it makes sense for them to quit the cartel if they want to have their own policy and be kind of independent, but you're still at the mercy, at least the whole world is at the mercy of OPEC, of the cartel, because they are the biggest producers, so they are able to make market moves. Falls in gold prices now imply developing countries across Africa and Asia will need to pay well over 10% in interest to issue new dollar debt. I don't understand why we always have to issue in dollars. We need to find new reserve currencies. With what the US is doing right now, the confidence in the US dollars is not as high as it was, when we came out of the European War of the 1930s and 1945. I don't want to call it World War because it was really a European war. Some nations, such as Kenya, Egypt, and Pakistan, have turned to IMF bailout in the last year to limit the risk of refinancing the debt in the years ahead while committing to painful reforms. In recent months, many governments have also turned to private loans or other ways of raising money in the short term, like i.e., JPMorgan's. Angola issued bond just to bond subject to the margin call earlier this year to secure a one-year loan from JPMorgan, known as a total return swap. Right, and I'm going to illustrate what the total return swap is right here. So, total return swap, you have two parties. There's a diagram here. You have a payer of the total return swap. You have a receiver of the total return swap. The payer of a total return swap, one of his main objective is to um, transfer this market risk to the receiver. And the receiver is gaining credit risk exposure to the payer because it relies on the payer credit worthiness to pay him accordingly. And the payer is relying on the receiver market risk. He takes over his market risk by paying him a fixed rate, which is the LIBOR plus a spread. And the LIBOR stands for London Interbank Overnight Rate. So in the banking system, you have minimum capital requirement, right? Because you're only able to lend a certain uh, percentage of the capital that the bank owns or holds. So when the value of so let's go back. So now at the end of the day, you have when you have excess capital compared to your requirement, so you have excess capital compared to your requirement, you can lend the excess capital to another bank that has a deficit in capital requirement. So that rate is the LIBOR that the bank in London exchanges every night. That's the base of this spread here. So you have the LIBOR plus the spread. So this is what the total return looks like. And no notional, so no money. So if the no money is exchanged at the right off the bat, at the onset or even at the end, there's no money exchange. Only interest payment and fixed payment are exchanged over the life of the contract. The deal was designed to tide Angola over to cover debt payments that come due this year, while it maintained too costly to issue a regular US dollar bond. People familiar with the transaction said. This week, the bonds were marked down from just under 100% on the dollar to as low as 85 cents on Monday. That sent their value below half of the loan. So half of the loan, of course, JP Morgan is going to make a margin call. On Friday, the bonds were marked at about 90%. All right, weird way to end the article, but there you go, guys. Angola is able to answer the margin call, and they posted 200 million in margin maintenance, which is great for them. That means they have available cash, and they don't have to go to the IMF. All right, guys, let me know what you think in the comment, and I'll see you at the next one. Bye bye.